when Justin asked me to moderate this, I asked him for two things. I said, please don't give me the panel right before lunch, and I wanted the most non-diverse group, and I'm before lunch, and this is a very, very diverse group, so appreciate that. For starters, I'd like to thank each one of the gentlemen in the panel. For starters, Mr. Bill Dunkelberg, Chief Economist for the NFIB, Mr. Ray Dillon, former CEO of the Deltic Timber Corporation and a GSE board member, Mr. Jim Parke, the CEO of Otter Products, and Mr. Wally Hawley, co-founder of Interwest Partners, former chairman of Young Living, and currently sits on the board of multiple venture firms within the U.S. So without further introduction, I'm going to turn the time over to Bill to get started. The format that I'm going to use is going to be a little different than the previous. So after each one of these gentlemen speak, I'm going to have I have some questions that I've prepared, and then I'm going to ask them the questions, and then we're going to break for lunch. So it won't be open to the floor. We'll just do it in that format.
All right. Hello, everybody. Kevin, thank you for that introduction. I could definitely say of all the intros I've had, that's definitely the most recent one. But I like the efficiency, you know, I like not going, that's very good. So I learned I was reminded of a couple of very important principles this morning. One is the importance of information and timely information. When I arrived here, I found out we had 4 panelists, but I've been operating on the 2-panelist model, so I didn't know, and so that would have been a good thing to know. But I also was reminded of an attribute of small businesses that is terrific, and that's we're agile and quick, and we adjust. So in about 10 minutes, I adjusted my PowerPoint presentation to fit the size of our panel today. Hopefully, if you like what you see, there's a lot more, especially the cartoons that I took out, and I'd be happy to provide you with the full one, okay? So, all right. Small businesses. So here's a little chart that just reminds you about how important they are. 90% of all the employers in the United States have under 20. The employer firms, so that's small. 99.5% have under 500. That's the SBA's definition of a small business. The latest estimate says we produce about 45% of the private gross domestic product. So down a little bit from the number that I have up there. And we employ about half of the private sector workforce. And, you know, you hear that word all the time, we create 2/3 of the jobs. You say, well, if you create 2/3 of the jobs, why do you only have 45% or 50% of the private workforce? And the answer is we fail a lot, too. That's part of the whole process. We are the R&D of the U.S. economy. Everything starts with us, and it grows out of us, or whatever it's going to do, but that's what happens. So we have a lot of turnover. All right, so let's take a look at this. This is for Table 8 from the BLS. It just shows you that if you look at the red line, that's a so-called burst of enterprises. You can see that not only did we build too many houses in that period up to 2008, we also started too many firms. So there are a lot of firms being started there. And then, of course, the recession comes, so the blue line tells you what happened to a lot of those firms. We lost them. They're gone. And now if you go on to the far right of the chart, you can see we're kind of back in balance where we do have far more new enterprises starting than we have leaving, but it's a very dynamic process all the time, coming and going, and that's what's really good about the U.S. economy. We at NFIB has about 300,000 member firms, and we've been collecting information from them since 1973. At the beginning of every month, we mail 10,000 questionnaires out, and of course they come back in over the month, which allows us to separate your responses when interesting things happen, like an election, and I'll show you what that looks like in a minute. But every 3 years, we send out a list of 75 problems and ask you small business owners to rank them in terms of their severity. And you can see the 2016 numbers, rising healthcare costs. That's been number one since Paul Volcker was at the Fed, when the only time we had credit availability and costs hit the number one spot. So rising healthcare costs is always there. The cost of regulations and red tape, federal taxes on business income, uncertainty about the economy, tax complexity, uncertainty about government policy, frequent changes of the tax code, property taxes, which takes away the earnings that we use to grow our businesses, state taxes, same deal. You notice that government is there all the way, government, government, government. This is the first time that we've had a real kind of business problem hit the top 10. And you can see it there, finding qualified workers hit the top 10. And if you want to know the rest of them, well, we'll send you a monograph that shows you the results from all the surveys from Volcker's time on, and it's kind of interesting to see how those things change over time. So what we started doing with the information that we collected from our sample was trying to get information about performance in the economy. So this is the Small Business Optimism Index, has 10 components, and I'll show them to you in just a moment, but I just want to make a couple of points. One is the average of the index over the 45 years we've been collecting the data is 98. The second point I'd like to make is that during the 2009, when the expansion was started again, when the recovery started, between 2009 and 2016, it never got to the average. We never got there. So it was a totally below average recovery. And the last point I'd like to make is looking at the far right-hand side. That's what happened to Optimism Index after the election was announced, okay? So let's look at this table here. That's the 10 components are listed there. To the left, you can see it's job creation plans, job openings, their credit expectations, capital spending, all that kind of forward-looking stuff. In October before the election, the index value was 95, which is 3 points below the long-term average. In the first week of November, before the announcement of the results, it was still 95. Then we announced the result, which was something that most people didn't expect, I guess. And then you can see the last part of November, the index jumped to 102, and December went to 105. And going all the way through, I did have it monthly, but there are too many months to get on the chart, so now I have the quarterly measures. And we do very big surveys with a couple thousand respondents in January, April, July, and October. And then I've got on Tuesday, we released the June numbers. That's a small survey of about 700 respondents, but look at the number. The index is 107.2. That fell 0.6 of a point from the prior month, but we've never seen numbers like this. It's totally unprecedented in the survey history, and you can see big changes there. You can see how pessimistic they were. If you look at expected business conditions, or how pessimistic they were right after the election about where the economy was going to go and how quickly they became very optimistic. Now, optimism is nice, but it doesn't create jobs, et cetera. So you have to see things happening, and that's what we were, of course, looking for in our data, and we found it. So you just quickly see how big the change was, starting with, of course, in this it'll be starting with January, because the red dots are all the big surveys, January through the first month in each quarter, but you can see what a jump it was. So I'll just look at it and notice how big it was. Expectations for business conditions, everybody suddenly thought it was going to be really great. Now, we didn't know anything about Trump's policies, right? We just knew he was elected, that's all. But apparently, just knowing that there was a change in the management team in Washington was enough to inspire our small business owners out there. They got very excited, even though they didn't really have many details. Although if you look at that list of problems, that was what Trump said he was going to worry about, taxes and regulations and all these kinds of issues, healthcare costs. How about, is now a good time to expand your business? Well, you can see that the answer was no. But suddenly, we're now at record high levels. The percent of you out there who say it's a good time to expand your business. When people said no, we said, well, why? Is it a bad time to expand your business? And of course, the usual answer, about 50%, was bad sales, weak economy, et cetera. But the second most frequently cited reason for being a bad time to expand was political climate. So you can see how that climbed and now is kind of going back to normal levels. Here's reported changes in sales in your last 3 months. Were sales higher or lower than they were the prior 3 months? So this is the net percent who said higher. Well, look at that. And you can see how bad it was in the recession. You and I didn't spend any money, and so it was tough out there for the small businesses, as we know. But you can see things are really hopping along on Main Street now. That's really good. How about earnings? Reports of earnings, quarter-on-quarter gains, 45-year record high levels now. Things are really working well. Well, why is that? Well, one, sales are strong, so that's really good. It's easier to make money when sales are strong. Two, you got a tax cut. The tax cut hasn't really set in for small business owners yet because we're not sure what impact that's going to have. But we got the regulatory tax cut. We got that going on, which is very nice, and everybody enjoys that in their own special way, depending on how the regulators were treating you, which was not well. But there are a lot of things that are helping the bottom line besides the tax cut. Job openings, record high levels of our firms say they have a job opening they can't fill, which is kind of interesting. So we became curious about that a couple years ago. And if I can get it, there we go. And so in 2007, and then again 10 years later, we did a study asking you, the small business owners, what's the main reason why an applicant is not qualified for the job that you're advertising? Remember, we're not high-tech firms, most of us, out there on Main Street. You know what that looks like. So you can see that the typical response was, of course, the applicant didn't have the skill set, like wanted to be an auto mechanic or an electrician, didn't have the skill set, so that would disqualify them. Then a poor work history, how about that? But how about social skills? Look at social skills. And unreasonable wage expectations, and appearance, and attitude, all those kinds of, these are all things that the applicant could change without going back to school. You got English and so on, math on here. Without going back to school, take a bath, change your clothes, get the earrings out, or the beer can if you happen to have a beer can in your earlobe. I mean, these are the things that make people unqualified for the positions that small businesses were trying to fill out there. And that's very telling, and we could have long discussions about that. In the meantime, we're really trying to hire. Look at job creation plans. The question we ask is, do you plan to increase or decrease the total number of people working for you? So you might fire some, hire some. Net, what does it look like? Look at that. We're trying to hire like we never have in the 45-year history of the survey. We need people. We want to make stuff, but we can't make stuff unless we get some more workers, all right? And that's the issue that we have. So we're trying to do it. So what's the most important problem facing your business today? Well, typically, historically, it was a 1 and 2 between taxes and regulatory costs, those 1 and 2. This dominates totally now. Of course, taxes are down, regulatory pressures are down, so those aren't so important, but finding qualified workers, that's the key. How about inflation? So there's a lot of talk about inflation today. I just want to point out in this chart, look to the far left, you don't get inflation unless Main Street is raising prices. So you look to the left there, you can see Volcker's period. We see when Volcker came in and we beat inflation, right? Whew. But we had the net percent of our owners raising prices as high as 70%, Then there's an interesting little spike there in 2008 where we pop up there. You see that there, kind of 3/4 of the way through the chart. What were oil prices in that July of 2008? 140, right? 147, exactly. Oil prices were very high. And of course, we were raising prices to pass those on to our customers, but then the recession happened, so look how quickly we stopped raising prices and started cutting prices because we had lots of inventory we wanted to move, so we did. So you can see it's been tracking up. The percent raising price has been sneaking up, but it's staying pretty low there still. So there's no inflation there. That's one of my little cartoons that I left in, the Fed trying to forecast where inflation's going to go. None of us are very good in forecasting. I didn't like the Fed deciding to be so communicative and making it clear that they couldn't forecast either, but we kind of knew that because we knew they're just people like us. But there we are anyway. So that's picking up, but not a whole lot. This is our forecast for interest rates, highly related to the height of the chairman. So we do predict that interest rates will go up this year and next year. That'll be our forecast. This is the percent of you who told us you made capital expenditures, all right? Now, I had to add leasing after a while because we leased a lot of stuff, but just focus on the peak. Notice that our spending peaked in Y2K. Remember Y2K? All right, so the highest percentage of us were buying capital equipment in Y2K. Then there was the housing thing. But look what happened. Now, if you want to know why productivity is not looking good, there's 10 years where Main Street is not investing in productivity-enhancing stuff. We weren't doing it. We weren't making expenditures. I mean, it doesn't have to be high-tech, just a better shovel. Or maybe in place of the shovel, a motorized snow shovel thing or whatever. I mean, just making better equipment. If we weren't doing that, then productivity is not going up. And remember, half of the workforce is with us. So it's no surprise productivity wasn't looking good. I've got a paper that I've just about finished that looks really carefully at how important our investments are. And if you look at the results of the numbers, what it says is that the spending you make this quarter will have an impact on productivity 1 year from now. A big impact. But it takes a while. You make the expenditure, you have to learn how to use it, all that kind of stuff happens. And there's a lag, but it's really important that we invest so that productivity can go up. So now just a quick few comments as I try to conclude, hopefully in time. Economic drivers, well, right now the regulatory tax cut's really important. It's hard to measure because everybody's got a different regulator. But, in the last few years, we had record numbers of regulations in the Congressional Register. The EPA was doing 600 plus big regulations every year. And so you all probably are familiar with that. So having that just stop has been a great relief. Corporate individual tax cuts, of course, are very good, and we do have a large fiscal stimulus. This stuff tells you how important expectations are. Again, we took off not without any real specifics about taxes or any of these kinds of things, but because we knew a change in the philosophy to focus on the things that were important to us, which is free up the private sector, free up the Main Street, we'll get the job done, get out of our way, and it can happen. Risks, well, there are so many of them, and we've discussed them here this morning, so I thought I won't spend a lot of time on that other than, and I'm sure Paul McCauley's going to talk about some of these as well. But so we do have a lot of things, a lot of balls in the air, a lot of things going on which could impact how quickly we can grow, could slow us down. But overall, Main Street has been carrying the ball. Since December, after the election, the growth rate in this economy, GDP growth rate, has gone up about 40 to 50%. And Main Street is a big player in making that happen. And I'll stop there.
Good morning. My name's Ray Dillon, and I was asked to speak on commodities, and I'll call it the most famous introduction I've ever had was Dave Kotok introduced me this morning as the GIC's lumberjack. So I'm the commodities hard asset or the lumberjack of the GIC. But as it relates to commodities, I've lived in the commodity world all of my career in forest products, pulp and paper, and now sitting on a bank board making loans to row crop farmers and poultry producers and cattle ranchers. But when someone says commodities, what I think of, first word I think of is volatility. Volatility in demand, volatility in price, and then you've got the foreign currency exchange rate exposure. So my experience with commodities and investing in commodities, whether you're an investor or a producer, quite frankly, your money's made when you make the investment. You can't overpay. I know that's nothing new to most of you in the audience, but a lot of people in the commodity business depend on the market to save them. And I would say going in, you should never depend on the market to save you. You should have a plan that says you can make it without the market saving you. And then if it does, then you're a hero and then you're a genius. Because time generally is your friend in commodities if you have the discipline and depth to stick with it till the wind gets at your back, and then all of a sudden you look like a genius when you got more money than you can count. The other thing that I've learned in the commodity business over time is that low-cost producer status is temporary. What I mean by that is first quartile low-cost producer status today is fourth quartile tomorrow unless you innovate. Because of the competition around the world, people thinking and working harder, and quite frankly, there are places in the world where capital is more available than what we have here, and they don't have to earn the return that we do here. So it's a constant challenge for U.S. manufacturers, especially in a commodity-based business, to be able to invest, earn the cost of capital that's required, and quite frankly, make a auditable profit, which is the real key. As far as trade tariffs, we've heard a lot about trade tariffs this morning, and I would just comment that my comments around trade tariffs are based on the fact that we're on a level playing field as it relates to the tariffs, because whether the playing field's unlevel or not, I don't know, and you've got both sides of the story, one side saying it's even on that side and the other side saying it's uneven. But you know, I would characterize growing up in a pulp and paper and forest products industry that without competition worldwide driving innovation and efficiency, we would have just prolonged going out of business. So I think tariffs are bad. Tariffs are bad for U.S. manufacturers. They protect those that are outdated, that are undercapitalized, that are inefficient. And U.S. manufacturing today can compete and will compete if we know what the rules are as we talk about regulation. So it's forced us to be leaner, more efficient, and it's forced us to innovate. Recently, in Danielle DiMartino's recent edition of her new publication, The Daily Feather, she identified Indiana as the state with the highest exposure to a trade war. And she followed that with Louisiana being number 3, Michigan number 5, Iowa 6, Wisconsin, Alabama, and South Carolina as 8, 9, and 10. The reason I bring that up is call it the flyover economy or the middle economy that most of us grew up in, or some of us did. 25% of that economy is manufacturing. So when we talk about tariffs and trade war, I think about the retaliation of those or the effect of the reaction. And what is that? To me, it affects, first of all, demand. It has a negative effect on demand and U.S. products. Reduced demand in today's world has an immediate impact compared to 20 years ago on labor and labor hours, whether you fill a job or whether you add jobs, and the uncertainty associated with the future, because most businesses today, quite frankly, profit margins, they're not enormous, they're, in my opinion, thin, and you can't afford to be wrong. So, when you reduce output, it reduces the demand for commodities. When you reduce that demand, it reduces the prices and eventually the profits. And if you live in a world, as I have, in containerboard or lumber or timber, and today watching farmers and in corn and soybeans and rice, particularly in Arkansas, and if you're on a bank board, on a loan committee, making loans to those individuals, at what rate, and do you really think you're going to get repaid? Bottom line, what I've heard here this morning is that this talk and trade discussion may be small, but on Main Street, it's real. It's causing people on Main Street to pause. It's causing uncertainty, and quite frankly, it's scary because of what you hear and what you read. Most of those folks aren't sitting in this room today, and it's hard for them to be patient. So I would just tell you that the trade war tariff discussion is having more of an impact at the Main Street level, and the decision that small businesses are making today at the Main Street level. So I think we're playing a high-stakes game of chicken, and I hope it turns out, and I hope Mr. Trump knows what he's doing. Thank you.
All My name's Jim Parke. I'm the CEO of Otter Products, and I am not a guy that engages in economic research. I'm not a guy that puts together slides and PowerPoints, although I have learned something interesting today. I recently read a book called The 5 Languages of Love and realized that for economists, graphs are that 6th language of love. Next year, if I have the chance to present, I promise to have a whole lot of slides with microscopic font and flip through them faster than you can see or understand them. I apologize.
We're all bleeding.
Yeah. I'm a tax lawyer. I've heard it from all of you my whole life. So just an introduction. Otter Products is a global leader in smartphone cases. We have about a 45% market share in the US. We distribute products into about 56 different countries directly and into a whole bunch of other countries via the internet. We have employees in 13 different countries and try to manage a business with a global culture. Our gross revenue on an annual basis exceeds $1 billion, and we have manufacturing primarily in the US, China, and Mexico. I tell that to you as a little bit of background on the opinion that I'll express and some of the things that I'll share with you today, because the impact of the trade war is real. So much of what happens and what drives investment decisions and what drives business decisions is psychology. It's not based on necessarily what the numbers mean, but what the numbers make you feel. And you are absolutely right. Most of the people that are making those decisions are not watching Forbes every day. They're sitting at home and they're watching Fox News and they're watching CNN, and they are scared out of their minds. And a lot of the information that is being fed to them is grossly exaggerated, because that's what happens in a 24-hour television news cycle. But it still drives behavior and it drives decisions. One of the things that is scary is when those fears actually come to roost. Our largest expense every year, in the scores of millions of dollars, is tools to build our products. We're a plastics company. And those tools are made out of steel. Now, I doubt that anybody is spending time thinking about what's happening to the consumer electronics and the consumer plastic division when they're talking about imposing tariffs and the impact of those retaliatory tariffs, but it's pretty significant when your tariff rate goes from 3% and raises 25%. Maintaining margins in the consumer product world with an increase like that can be pretty difficult. And on a macro level, that may not have a huge impact on the economy, but on a smaller level, has a pretty big impact. One of the other things that is a challenge that we deal with every day is the idea of IP theft. And that's been the justification behind a lot of these tariffs, that we have to put punitive tariffs on China because they refuse to protect US intellectual property. We lose tens of millions of dollars every year to counterfeit products, and they all come straight out of China. And that's a problem that we deal with on a day in and day out basis. It hasn't been helped at all by the tariffs. As a matter of fact, that's only made our business more difficult. The financial challenges that we face because of that IP theft have been heightened by the tariffs that have been impacting our business. We've seen those tariffs come not only out of China, but now out of Canada. I'm sure many of you have seen the coolers that we have out there. Our duty rate's now gone up 16% to ship those products into Canada, which was a primary market for the development of that product. That's not something we had seen or anticipated, but that's a real impact. What it means in the big picture is that we have to take a wait and see approach, because we don't know what's happening to product margins. We don't know what's happening in the long term, and we have to wait and see how this is going to impact business. Now, I speak not just from the perspective of Otter Products here. I also manage a venture capital firm, Blue Ocean Enterprises, and we have a couple of $1 billion deployed around the world in various industries, and through all of our businesses, we're taking that wait and see approach. Instead of investing in M&A in a market where multiples are really high and exaggerated, we're paying down debt, creating borrowing capacity that we may be able to take advantage of later or may not, depending on what happens to product margins. Ultimately, we're already seeing and having discussions about how this leads to price increases to customers. And that's a real thing. We're seeing the margin pressure from our retail partners that are asking for us to eat the cost of the additional tariffs. That works for a little while, and then business becomes unsustainable. And so somebody has to step up and somebody has to pay that price. Ultimately, it passes on to the consumer. And that's one of those things that businesses will try and shield people from, but in the long run, it's not going to work in the long term. One of the biggest challenges that we've seen is the cultural impact in running a global business. Now, I mentioned we have employees in 13 different countries. When the US is the bad guy everywhere in the world, people are not super excited to work for a US company, which makes recruiting enormously more difficult internationally, makes retention of employees more difficult internationally, and the immigration law is making it more difficult to hire qualified foreign workers here in the US. This is a real issue that we have to face. I'm going to be in China next week, and a big part of that is to spend the time and put in the face time just to help people see that we're not the bad guy. Because they're seeing the same thing that we're seeing, but from a very different perspective. It's not make America great again. It's America's trying to screw the rest of the world every day. And that is really difficult to maintain a global culture with a positive, happy environment where people are productive and making good decisions when that's the environment that they're living in. One of the other things that I would say is that if you ask me what keeps me up at night, the thing that terrifies me the most is not the tariffs, it's the retaliatory compliance coming out of China. Because so much of our product is manufactured in China. And, there's a different standard and level of ethics that you deal with over there. And shipments can get held up, factories can get raided. There's all sorts of things that happen to the very most ethical companies that are completely beyond your control, and there's zero recourse. There's zero recourse. And very profitable, very successful businesses can be changed and harmed overnight by that. And we've seen lack of consistent enforcement of a lot of Chinese regulations for years. That scares me to death. That's the thing that I am most worried about right now. There's a lot going on in the economy, and so much is good. I don't want to paint too bleak of a picture. Our business is growing better than it has for years, but the level of employee confidence is declining because of what they see in the news every day. The impact of the current political climate and the current economic climate has a real impact on people psychologically. And I hope that people keep that in mind, that there is a very different impact on Main Street than there is on Wall Street. So, thank you.
I'm from Silicon Valley, and we have discovered a new thing called a tie and a coat. And we're going to have those pretty soon, wearing them out there. So I apologize for not being dressed appropriately for the rest of the panel. They asked me to speak on venture capital, and then they put down the fact that I'm a former chairman of Young Life, which is a Christian youth organization. So let me just tell you what Young Life is, which has nothing to do with my talk. Young Life is a non-denominational Christian organization that has camps and clubs around the world. We have 1 million kids in these clubs, and we're in 191 countries. And it's just a wonderful thing to watch these kids grow and get good values and everything else. So that's Young Life. That's a piece of what I've done. It has nothing to do with what we're talking about this morning. In early 1970s, I formed Interwest Partners, and we raised the grand sum of $30 million, which was nothing. It was 10% of all the venture capital raised in that year in the U.S. I looked around and I figured, all right, we've got to find a way to both raise the money and build and grow and do something different. So first of all, how did I raise the money? It wasn't me. I was a consultant out of McKinsey. People were going to just give me. So what I did is I built a board with the head of Caterpillar Tractor, one of the senior people from McKinsey, one of the senior professors in the business school at Stanford. And it made money raising a lot easier because it wasn't me, give me the money. These are the people behind us that are really going to help us build this thing. And it made life easier. Well, a lot has happened since then. We took a look at it and said, Silicon Valley is really crowded. There's tons of venture capitalists out there. And so if you go to a party and you tell them you're not with venture capital, you're just out of it. You know, you're not, who are you? What are you doing? And I said, this is going to be too crowded. affect pricing and everything else. So we set out to build a network. And if you think about it, the good deals originally back in the 70s were mostly in Boston and that area, and of course in Silicon Valley. And then as time went on, as many of you know, because some of you are involved in funds, there were venture capital deals around the country in different areas. Well, how do you do this? You can't get on a plane and fly to Denver and say, where are your good deals and what do you do and everything. So my philosophy was, well, let's leverage, and let's leverage on not only regions, but let's leverage on people. So what we did is we found really good people in a number of cities, and we put up funds. So we had a fund in Denver and Atlanta and in LA, and on it goes. And the beauty of that was, A, I can't get on a plane and fly to these things. See, we have people on the ground, they know it. They also can work the deals once they're done. So it worked out very well. We got a big network. And the flow of funds and deals coming in makes me now a lazy venture capitalist, because all I have to do is look at what the funds are doing there and their boards and their talent, and then what we can do is say, all right, I like that deal you're doing. I'd like to be part of that. And I'm on your advisory board, so I get to do it. So it's a way of sourcing. It's a way of turning it into national, because it's no longer just a couple of areas. So when I see and talk to people in here that are talking about venture capital, a number of you are, let me make a couple of comments of what I'm seeing and hearing. I think in some cases the thing that would worry me is some people who do it for a very narrow region. Good deals aren't clustered in all these places. Silicon Valley's maybe an exception. So one of the things you want to do if you have a fund is, all right, what's my geographical region that I want to reach, and how do I get there? The second thing is, what skill sets do you get to help your partners? There's usually very few partners in a venture firm, but I've seen some here that are saying we've got 2 partners. Well, 2 partners doing a venture fund, my reaction is good luck, because how much can you know about different industries and different talents and monitor them? So how do you spread that? Well, if you get an advisory board, and then you have an advisory board in all these funds around, you have a network. So if somebody wants to do something in biotech, I don't have anything in my firm does biotech, but I sure know of a firm that has it, has the guys, and then you can refer it on out and make it happen. So I encourage you to look at, what have you got beyond just where you are geographically. And then the second is segments. You've got funds that are narrow, all right? That can be an opportunity, but it also can be a problem, because in your area or locale that you have it, how much concentration do you have from any industry or 2 industries? So it's very hard to say we do have a fund and we build, just in biotech or whatever, because it's going to be very limited. So you need to think about, how am I going to get the talent in here? And what it all comes down, in my judgment, is people. If you think what we have in a network right now, we have people sitting in all these cities that are talented, helping to run the companies that they invest, helping to source companies for us. We can then help them, and it spreads out. So it spreads out in terms of the talent. Right now we have 3 sections in our fund, which is consumer goods, which we've been doing before most people were doing that in venture capital. But we also have the classic high tech, and we have the healthcare biology. And we have segments, and then we have these funds. So one of my recommendations as far as venture capital is, if you're going to build a fund or be part of a fund, think about the skill sets you want to add. I see venture funds raise money, and what do? They put on their advisory board the people who gave them the money. Well, yeah, but what else can they do, and what else do they bring? So when we think about it in terms of forming a board, we think about, well, what do we need here? I mean, yes, there'll be people that'll be bringing money, but we have a skill set, and we want this person to be able to do this, and we go out and we build a board that way. And then money comes with it, sometimes directly with them, sometimes not. But if you build a board and you're a venture capitalist, and all you have is people who are financial people, they're talented, but a company needs a lot more than a bunch of financial analysis. So I think one of the key elements, if you're a venture capitalist, is make sure you're building breadth of your people. The building of growing in terms of what's going on, one of the surprises to me is that there hasn't been more of this in Europe. And I'm not sure why, because it's proliferated here and it hasn't done that much. There's been some in London, some a few else, but not much. Now, I have a hypothesis on that. Some of the people who want to give funds to you, who may be in Germany or in Holland or whatever, they want to put blinders on the people that are doing and saying, we will give you money to form a venture fund, but we want you only to invest in Netherlands because we're Netherlands. That is the kiss of death, because how many good deals can we find in Netherlands with a fund? So you're going to be sitting in a matter of time with not having done many deals or compromising enormously on the kind of deals you are doing. So my whole philosophy on this is it's about people, and there are ways to leverage enormously. When I think of the number of advisors that are in these funds that are around there, and I can reach out and say, I know someone in that advisory board and that fund knows how to do it. And it makes life easier, cuts down on airlines. If you're going to work the companies you do, how do you do that if they're all over the place? So we have a strategy of build the people, grow it, build talents, build skill sets in your advisory boards. Don't limit the number of partners that are going to work in this. You know, a one or a two-man, just it isn't enough to make it happen. I'm really blessed to have great partners and great people around the country that are making this happen. And my whole philosophy is the only way I'm going to win is to get together with a whole bunch of people that are smarter than I am and let them have at it and applaud, and you know, it's great. Now, I want to say a word about the Bronze Buffalo Club, because they've just let me get in as a part. So they're compromising their standards right away when you see what's happening here. But that'll get self-corrected. These people, two guys, Cody and Justin, have done a remarkable job. And I look at it as a venture capitalist, and I say, two guys, and look what they've done. You know, they've got the horse things, they've got the golf course, they've got on. And I am astounded. If they ever decide to do something with a for-profit, I'm all in. But I just want to give them a hand for all the things that they've done here. Thank you.
So one of the challenges that I had when I was asked to moderate this panel was the diversity and the backgrounds of each one of these gentlemen. I mean, I could have spent probably hours here just introducing each one of them. Their business experience is tremendous. A lot of that information is provided right here. I recommend that each one of you take a look and spend some time, and even personally asking them questions, because I had that opportunity before moderating, and they're a tremendous wealth of information, well beyond what they've been able to share with us right here. But I wanted to ask each one of them one question, and then I guess we'll break for lunch. So I was going to start with Wally. With the increase in cash and available to these VC firms, the venture market has become increasingly competitive. So what are the key factors for VC firms today in this current market? Like how do they become successful?
That's as close as I
Is
can
it?
get.
We got it, okay. One of the things that the venture firms have problems with is not the money. It's getting the talent of people who are experienced in building a company. And so if you are a company and you're talking to venture capitalists, be careful that you're not falling in love with the name of the firm versus finding out who from the firm is going to be working on your company. Because what's happened is that money has come in, like you say, the firms have expanded. So you have everything from the senior partners who've been around and done this forever, and then you have people who've just gotten out of business school and are joining the fund. What you don't want to do is have that guy that just came out of the business school put on your board, because he's learning from you, not you from him. So if you're doing that and you're talking to a firm and you think, okay, we might want to get this, first question you want to ask is, if you invest in me, who from your firm are we going to see at our board meetings and working? Because that is a big difference of what you're getting in a firm, not just the moniker of the name. So that would be one of the things I'd think about. The amount of capital, there's a lot of growth because, as I said originally, if you go back to the 70s, there was really only 2 small pockets doing this. So I think there's plenty of room. I think it's getting the right people doing venture capital that's the shortage, not the capital.
Okay, thank you. My next question is for Jim. And Jim, with the issues U.S. businesses are facing with theft of intellectual property and tariff disputes, what impact do you see with these two conflicting issues, and what are the effects on U.S. businesses?
Yeah, well, I don't see them as conflicting issues. I see them as two completely separate, unrelated issues that somehow people in Washington are trying to tie together and say that doing one will solve the other, which is just absolutely not the case. They both have a very real impact, and the solutions to each of them are different. As a consumer product brand, a premium consumer product brand, we deal with the IP theft on a daily basis. Most companies don't have to worry about that. Unless you're truly running an international business, that's not a problem you have to deal with. Tariffs are going to hurt a lot more companies in the U.S. than I think the IP theft will.
Okay, thanks. My next question is for Ray. With the current competitive environment in manufacturing within the new global economy, what are the biggest challenges U.S. manufacturers currently face?
It's been said several times here before, but it's real. It's workforce availability and workforce development. Just a short, where I first started work was in a small town in Bogalusa, Louisiana. It's a paper mill. It's over 100 years old today. Whenever there were 50 jobs open in that mill, you would have almost 700 people lined up for those jobs. Today, those same 50 jobs, you may have 50 people for those jobs. And it's because the perception that they're a mill job, and quite frankly, it involves work rather than looking at a computer screen. So I go back to workforce availability, workforce development, and quite frankly, people that want to work. That's the biggest challenge that U.S. manufacturers face today. I hear it in every town that I stop. Why aren't you expanding? Where am I going to get the people? And I would just say we've got to fix immigration in this country, and we've got to make it to where we can employ documented workers so that we don't run the risk of going to jail.
Thank you. And my last question will be for Mr. Bill. Small business has represented the largest amount of growth in the current economy and have been. So what do you see as the trend going forward?
Yeah, I would make a couple of quick observations. First of all, one of the discussions we've had is about the availability of labor, and I will point out that the percentage of our owners in the survey who report raising worker compensation is at a record high level. So we're doing the most obvious thing that you do to get workers, and that is pay more. So we're trying to do that, but we will have to change our standards a little bit. We'll also have to engage in other kinds of workforce development because, invest more in training. We're going to have to do something to make that work. Another thing I would point out that's important going forward with the small business sector, I was involved with a small bank. We finally decided to merge it with a larger bank, and the main driver of that was not that we thought things were going to get bad going forward. It was compliance costs, just eating us up. So, and what benefit was anybody getting from that? But it was certainly attacking the bottom line, to say the least, especially for small groups, because if you need an accountant, it's hard to buy a piece of one who works on compliance. You got to buy the whole thing. Anyway, so I think that's really an important issue going forward. And I think that the good side of that is that we're reducing the burden now, which means that compliance resources that may not have been producing much of value can now be used to invest in real productivity enhancing kinds of stuff. And as part of that, one of the most important asset that I think demonstrated by the speakers today, the most important asset a firm has is the time and the mental capacity of the entrepreneur. And the more of that we divert, to this useless stuff on the side, the worse off we're going to be. So again, I think we're headed now in a much better direction. So I think that over the next couple of years, the small business sector is going to be, a very large part of the growth picture, the growth story that we have here in the U.S.
Absolutely, go ahead.
You asked about, all amount of venture capital and how do you deal with it. I think there's some self-correcting going on. First of all, when I define venture capital, it's not just seed capital. That is a piece of venture capital. That is a very small piece. And if you look at the number of companies that we have backed and our colleagues around here, probably 10% or less are startups. We put a lot of value on having the fact that if you've got something with so momentum, you're seeing a product, you're seeing a market, you're seeing the people. The risk that you take to do that is so much lower. Now, you may not get 200 times your money, but you don't need that. So what we do is we define venture capital as private equity, not leveraged buyouts, but private equity. And it can go on up to companies that are already doing, 50 million, 100 million, but they need growth capital. So when I'm talking venture capital here, I'm talking much broader, and that helps self-correct. The second is investors are getting smarter of looking at the return of a venture fund, and you no longer have the opportunity to not do well in one or two funds and then go out and say, would you like to back me again? So there's going to be a lot of funds that have been formed, and 5 to 10 years from now, they're not going to be around, and that's going to be a partially self-corrector.
Well, I'd like to thank each one of the panelists for participating. As I said earlier, I would suggest that any of you that have any questions, ask them individually. They're very open, as they were with me when I was asking them questions, to anything and everything and anything that I was willing to ask. They were willing to answer and spend as much time as possible. So I'd like to thank them and hope they enjoy their lunch.